All right, good morning, ladies and gentlemen, and welcome to Macro Ace with your host Tony. And we have the Bank of England interest rate decision in about an hour's time. Alongside that, we get the monetary policy summary and the monetary policy report. So the expected hike today is for a 25 basis point hike to 0.25%. Excuse me, to 1% from 0.75%. And if we're looking at the charts at the moment, just before we go into other bits of detail about the Bank of England, what to expect from them. So currently down on cable about 0.3%. And then if we look at Euro GBP, a similar move, but except we're up about around 0.4% on the day. So nothing. So pound or sterling is down on the day so far before we get the rate decision from the Bank of England. But that's just something that I wanted to show you before we go into any further detail with the Bank of England. So the Bank of England then, what is it? What is the bank rate, right? That's what we're focusing on. So it is the rate that the bank pays interest to commercial banks. Hey, David Sini, good morning. Good morning, traders indeed. Good to see you again. Hopefully you enjoyed yesterday's live stream. And I hope you found it useful too. So as I was saying, so it's the rate that the bank pays interest to commercial banks, just like the ECB does with their deposit rate. The bank you would have banks putting in money into the central bank in return for interest for the amount that they put in. So that's basically what it is. And usually when the central bank starts to pay back or pay interest to these commercial banks, that is a sign that the economy is up, or that the bank thinks the economy is on the mend and is starting to pick up a little bit of steam. Otherwise, they wouldn't be, if we're talking about recessions, or if we're talking about COVID era like pandemic economic issues, then the bank would want to keep rates as low as possible, so they don't pay out too much interest to commercial banks, but instead those commercial banks can use their reserves that they have and provide that as a loan to consumers and businesses and anyone who's got a mortgage and so on, was paying back interest. You can borrow more to pay back what you already owe. But that's in its basic way to understand it. Commercial banks get paid money for putting money into the central bank, and the current rate of that is 0.75%. So why is it important? So the higher rates are usually what that equals is that is to try and slow down growth or make sure it doesn't get out of hand. And the other reason why there are also high rates as well is to control the level of inflation. And we'll go through where the economy is at the moment so far, and what the future prospects look for the economy according to the Bank of England's last statement and other comments that had come through after the Bank of England rate decision back in March 17th. But usually high rates is not to stop growth, but to slow down growth or make sure it doesn't get out of hand, and to control or dampen inflation pressures. And of course, with lower rates is there to support or create growth. So if you have low rates, you're looking for, so businesses, so those commercial banks can provide their loans at a cheaper rate, and because they're not having to provide so much, they're not having to raise their interest rate to match the Bank of England's. So that's why low rates can support and create growth, and in general anyway, in an economy you'd expect that. So there'll be more borrowing of credit. Maybe there are people taking more bigger loans out, or mortgages, or paying, or they're able to pay back the debt that they've had or the debt that they have in the past much sooner with a lower rate of interest. The other reason why lower rates could be a good thing as well for the economy, or usually can be a good thing for the economy when it's on the low, is to is to help build inflation. So if inflation is quite low, or there's the risk of deflation, okay, where we go below 0% with inflation, then lowering rates, of course, as said, if it is there to help increase borrowing and spending, that is going to help increase the rate of inflation as there's more demand for goods within the economy. So, of course, we're looking at the higher rates, or the rates going higher in the UK and also globally as well. And as said, it affects banks handing out loans, mortgages, and credit, and etc. as well. So again, wherever the Bank of England sets their rates, then you would have other commercial banks that will set their rates similarly to the Bank of England, and then of course that will raise or decrease the level of interest that banks require for loans or any other or taking of or creation of credit. So as already seen, we've seen that the rate is back to its pre-pandemic levels with the last release, or the last meeting that we had. Good morning, MV Jin Lin. Hopefully all doing good. I know it's if you are in the US, I know of course it's it might be slightly earlier than of course maybe your usual time to kind of maybe prep, or maybe this is your perfect time where you kind of get up in the morning and prep yourself for the day ahead. Is there an actual website for macro ace? Yes, there is. Well, not there is an official website, but then that goes to the mailing list, where it just talks about what it is. So I'll put it in the chat here for you, so you can have a look at it. Joining from sunny Lincolnshire. Okay, beautiful. But yes, so the link is there on the financial on the chat on the feed there. If you want to have a look at it, you can also sign up to our mailing list. But that's something that I'll go later on in a bit more detail. Then, so where is the economy at the moment? So we have the unemployment rate that is at 3.8%. Versus a prior of 3.9%. Yeah, I mean, if you would like to sign up, then what you can do is that link. If you click on it, then you can sign up to the mailing list, and that will automatically add you to our mailing list. But I appreciate that. Thank you very much for your support there, Anthony. So, unemployment rate was lower than the prior release, 3.8%. Employment change came in at 10k versus the prior of minus 12k. And then inflation, again, quite high at 7% versus the prior of 6.2%. UK average weekly earnings year on year. Again, one other factor, or the central banks globally have been keeping an eye out on, such as the Federal Reserve and, of course, the Bank of England. And they don't want wage prices or wages to spiral out of control, where you have a rocket fuel being given to wage increases, where if you're able to spend more money, that will lead to stronger inflation. So of course they'd want that to grow at a steady rate, but they don't want it to grow too out of control, where to the point where the inflation starts to heat up again, and then the Bank of England might have to take stronger action to rein inflation in, or to try and slow down the economy more. So the UK average weekly earnings year on year currently at 5.4% versus the prior of 4.8%. And then if we carry on, so 2021 fourth quarter GDP was at 1.3% versus the prior of 1%. A lot of it, or even though we had seen a slight increase in GDP, the main factor that impacted GDP was Omicron, that impacted retail and hospitality. We've been quite strict with our lockdown measures in the UK during the COVID pandemic, of course, or although there may be some political issues with the government, maybe having parties here and there, regardless, the UK has been quite strict with it. So more or less, that seems quite obvious that retail and hospitality would have taken the biggest hit in GDP figures, or would have taken the biggest hit in the gross domestic product report that we had from the UK. GDP year-on-year prelim, it came in at 6.6% versus the prior 6.5%. So the economy, again, back on the mend, continuing to push higher quarter for the last quarter that we'd seen. And of course, today, so the rates, or the rate is to be lifted to 1%, which was a level last seen in 2009, which would be a 13-year high. So again, quite quick action being taken by the Bank of England to try and rein in inflation pressures first, and then also to try and slow down growth, so it doesn't so the economy doesn't overheat. So usually, we've got to remember our fundamentals. When the economy is picking up and expanding at a healthy rate, or is expanding, what that means is that productivity has also increased as well. And when productivity increases, you have more workers that have more cash in their pockets, and the more workers and jobs that are needed to fill that productivity, to make sure that it doesn't fall short of how quickly the economy is growing. So that's another reason. That's just one thing to bear in mind as the economy is picking up steam. So inflation shock. So this is a piece from Bloomberg, sourcing with Bloomberg analysis of IMF data. So it's just showing the average 2022 and 2023 of the inflation shock. So soaring prices are expected to knock 2% off Britain's economic output. So just something that I found quite interesting that you have with, so if higher inflation is, the more of an impact it's going to have on GDP growth. One thing you've got to understand is that with higher inflation, businesses will have to pay more for the goods or products or raw materials that they need to buy to make the final goods, or going through that process to make the final goods, and a lot of that is going to be passed on to consumers. So what that could mean is that if we do get, another thing is that if inflation does get quite high, or is continues to be quite high, or gets out of control, that can for consumers as well. You've also got to factor in that consumers would spend less money within the economy as well. So if there's less money going around, then that means that these companies that are creating these products or providing a service, remember about 85% or 80 or above, or 80% or more of the UK's GDP is made up of services. So there's quite a significant amount when we're looking at hospitality and services and the services sector. But that's one thing we've got to be aware of, that if there is a decline in spending and businesses providing their services or goods, might have to bring back or slow down their productivity if they're producing too much, or if there's not enough demand for these services or products that they have. So that could be, so that's a nice illustration again of showing how inflation can impact GDP. But not only does it represent the UK, but also shows the US, Germany, Canada, Italy, France, Japan. Japan's a whole different story. That is, well, of course, they've had record low inflation for a while, but they've been continuing to ease their monetary policy. And even then, it's going to take quite a while for inflation to get back up. Andre says, could you please share the rate hike expectations for the BV versus the Fed? We'll go through that in a little bit. We've already had we had the rate hike yesterday from the Federal Reserve for a 50 basis point hike. The chance of a 75 basis point hike was taken off the books when Powell said that that's not on the table. But for the UK, just kind of summarize, at the next 6 meetings, some analysts are looking for 25 basis point hikes at the next 6 meetings in the Bank of England. But we'll get to that in a bit more detail. But as you can see here, so getting back to this, so inflation in the US as well, you'd see GDP growth of 3%. And of course, if the 2-year average of inflation is around or above or just above 5% 2-year average, then again, that could have an impact on the US's GDP. But mainly for the UK, soaring inflation rates, as said, they see that it could knock off 2% of GDP from UK's economic output. Okay, so investment bank view. So this is what I'm going to go into about rate hike expectations. When it doesn't include the Fed, but we can, as I said, I kind of did discuss that in a little bit of detail. So ING. So the Bank of England is anticipated to raise the base rate by 25 basis points, despite markets pricing a 50-50 chance of a 25 basis point increase and a 50 basis point increase as recently as last week. Then you have they also say that a rate hike appears to be near certainty, with the main question being whether the central bank opts for another 25 basis point move or follows the Fed's lead and raises rates by 50 basis points. So ING believes that a 50 basis point increase is improbable as the Fed balances growth and inflation. So for the UK, if we're comparing the UK to the Bank of England, according to ING, their main concern is that the Bank of England is, if they're only focusing on inflationary pressures mainly, then they don't have. Of course, there are other things to worry about in the economy, but if that's their only main concern to tackle, then they won't have to take too drastic an action to try and rein in inflation or go too crazy. And one thing they don't want to do is to cause a recession with high rate hikes or big rate hikes. Whereas the Federal Reserve, as said, they have two focuses. So GDP, jobs data that comes out. Of course, we have NFP tomorrow, and how inflationary pressures are with the PCE price index or the personal consumption expenditures index. So they have two bits to look out for. Hence, they've been more aggressive in their rate hikes and tightening of monetary policy compared to the UK. So there are, of course, as said, there are different focuses that each central bank has when looking at when to raise rates and how much to tighten monetary policy by and when. Then Goldman Sachs, they say that there is a clear chance that Britain would enter a recession as rising inflation reduces household spending. That's according to investment head Bull, stressing that a contraction is not Goldman Sachs' central projection. They say that given the tightness of the UK labour market, the BoE is likely to raise rates again. And again, as said, that's according to the chief UK economist there from Steve Bull. April 11th with rate hike expectations. So this hasn't really changed. It's more or less stayed the same. But you have Goldman, Morgan Stanley, ING, HSBC, Credit Suisse, and BNP expecting a 25 basis point increase for this meeting today. So the previous Bank of England statement, so you had on April 19th, you had traders anticipating that the bank will raise rates will raise interest rate by 25 basis points in each of the following 6 sessions. So, as I'd mentioned earlier, Andre, that's what was said. Well, that's what I mentioned before. A lot of the market pricing, or the market trying to price in the Bank of England rate hike, has been a little bit over the place, similarly to the ECB of market expectations, where sometimes you'd see maybe a potential for a 50 base point hike in September, which is one of the expectations, or maybe slightly, or there might be, or there might not be a 25 base point hike in September, and they might instead cut down the amount that the Bank of England is expected to raise rates by over the over the year or so. But if we're looking at some of what the rest of the market is looking to do as well, or what the Federal Reserve is looking to do, and in the market participants' eyes, so you have Fed Fund futures yesterday, where traders saw about a 90% chance of the Fed hiking at 50 basis points at the June meeting, which was up from 56% before the May FOMC statement. So, of course, as said, Powell said the chance of a 75 basis point hike isn't there. And you also had other Fed members saying that it would be a shock, an unnecessary shock to the economy, such as Fed's Mester. But at the moment, so you've got the Bank of England with 25 basis point hikes expected at the next meetings, including today, next 6 meetings, including today. And then you have the FOMC, where they're looking for 50 basis point hikes now, rather than 75 basis point hikes at the remaining meetings, to try and get back to the neutral level of 2 to 2.4 or 2.5%. Okay, so a lot of the central banks that we've seen so far, when we're talking about the neutral rate is where central banks believe that they can control inflation whilst also making sure that growth isn't hampered too much, or isn't hampered at all, if they is what they try to do. So for the Bank of England, similarly around 2% as well. It's also similar to some of the other central banks too, but 2% is the neutral rate of what the Bank of England is looking at, or around 2%. So March 17th, the last interest rate decision that we had. So of course, 25 basis point hike is what we'd seen, is what was expected what was expected in the markets. So we had seen the Bank of England say that they forecast Q1 GDP to rise by around 0.75% quarter on quarter. And they also said that once the bank reaches 1%, that will mean the Bank of England will actively sell its gilts, or government bonds, or government debt, basically. So that's once we get to that today, then we'll probably, maybe in the monetary policy statement or some monetary policy report, we may get an inclination as to how much they're going to start reducing their gilt purchases by, or the surprise will be if they, for the markets, if they say that they will start, or if they've already, if they say that they're going to start selling gilts by maybe getting rid of it altogether, which is, so total gilt purchase at the moment is at £175 billion. And if they do decide to get rid of a big chunk of it, or nearly all of it, if they say they're this meeting, that'll be quite very surprising, and that could mean that there could be some upward pressure, or upward move, appreciation towards the upside for sterling overall. But we'll wait and see what happens. As I said, that's one potential scenario. Or as I said, they could just tell us later on how much they're going to reduce their how much they're going to reduce gilt purchases by. Excuse me, not gilt purchases. How much they're going to reduce their gilt holdings by. So, and also you had the last meeting, you had 8 MPC members that voted for voted to increase the bank rate to 0.75%. Cunliffe was the only member of the Bank of England that voted to keep the rate at 0.5%. And a reminder as well, you had Saunders. So Saunders is now seen as the most hawkish member of the Bank of England. It's very obvious he was looking for a stronger rate hike of 50 basis points rather than 25 basis points. So again, majority voted in favour for a 25 basis point hike or a hike. Cunliffe voted for no change, which of course it wasn't something that the markets were expecting. In actuality, what markets were expecting was for everyone to hike rates, and off the back of that, we had seen the pound weaken. And I'll show you the market reaction in a little bit. But that's what had happened last time when we had the Bank of England interest rate decision. So they also said that inflation is expected to peak at around 8% in the second quarter of 2022 or this year, possibly even higher later in the year. So again, inflationary pressures was one of the key things, what is the key thing the Bank of England is keeping an eye on. And also in regards to Saunders, he voted for a hike and a hike to end QE early. So rather than getting to the 1%, he was actually looking for something in the last meeting. Ideally, is what he was looking to do, to start cutting back on gilt purchases. So just to clarify then the positions and the sentiment, or how dovish or hawkish these central bankers are from the Bank of England. So Cunliffe, of course, at -1, showing that he's on the easing scale. Doesn't mean he wants to cut or reduce rates. All it means is that he just wants to keep rates where they are, kind of see what happens. But his commentary of what he said as to why he why he wanted to keep rates where they were is one of the main reasons. The main reason being is because of the Ukraine conflict, is what he noted last time. There was some uncertainties that had cropped out from that the Bank of England should be a bit wary of. Although it was the overall sentiment from the Bank of England, taking into consideration some of the impacts on energy prices for the Bank of England and monetary policy, it wasn't the overall rhetoric that we had seen from the Bank of England last time. But it's something that was mentioned, and Cunliffe had seen as a bigger risk, or had seen as enough of a risk to warrant that actually maybe we should hold off from raising rates. Similarly to the Federal Reserve as well, when we had their first rate hike back in March 16th, when instead of going for a 50 basis point hike, the Federal Reserve went for a 25 basis point hike instead, with Bullard being the only voting member to say, well, actually, we need a 50 basis point hike. But anyway, that's just a nice little image to show you what the current sentiment is and where voting members are. So as you can see, Saunders being the most hawkish member in regards to looking to tighten monetary policy even more. So again, just as a reminder as well for basic understanding, if you're unsure, when you want to ease monetary policy, usually that's seen as a dovish thing, or you're seen as dovish, or if you're seen as wanting to tighten monetary policy, of course, hawk or hawkish. So recent Bank of England member comments. So you had Bank of England's Governor Bailey said that we're walking a very tight line between tackling inflation and the output effects of the real income shock and the risk that could create a recession. and the Bank of England is facing its most severe test since independence 25 years ago, as it balances the need to raise interest rates to tackle inflation against driving the economy into a recession. So again, inflation being the key risk that the Bank of England sees for the UK, and also wage pressures as well that the Bank of England sees. Although inflation is currently outstripping average weekly earnings, the average earnings so far in the UK, is something that could in their eyes could spiral out of control, and something that they need to rein in. So you had Bank of England's man. So then we can look at whether or not an additional 25 basis points or more might be necessary in order to keep inflation anchored. And she said that while I recognize the risk of second round effects and that further tightening of monetary policy may be required, I'm not convinced that we will inevitably have to lean heavily and constantly against an embedding of inflationary psychology as we progress through this difficult period, and as the impact of high commodity prices on real household incomes depresses activity. If we go on, so if we look at the other market expectations too. So recently today, you have markets indicating that a 25 basis point increase is a done thing or priced in, but there's a 15% chance of a 50 basis point increase. So economists expect Saunders and Mann to vote for a 50 basis point hike, and Cunliffe is expected to vote no change. So this is one thing that we've got to consider. Okay, so in the last meeting, or the last Bank of England rate decision that we had, the expectation was for everyone to vote in favor of a rate hike, whether it be 25 basis points or 50 basis points. Okay, that was the expectation. Then what had happened was that we had the surprise of Cunliffe wanting to vote no change instead, which caused sterling to decline instantly when we'd seen the statement that had come out from the Bank of England. So that was a surprise there. Now that's not a surprise, and it's expected that he's going to vote for no change. We'll see how the markets react. Maybe if we do get the rate hike as expected, with the votes of 8 to 1, so 8 in favor of a hike and 1 in favor of a vote being unchanged, and 0 with the vote for a cut. If we see that the votes come in line with expectations, then and there is still a rate hike, we could see a modest move. Still, as I said, it is still priced in. We could see a modest move towards the upside from sterling overall. But if we do get a surprise where maybe you have 2 members who vote unchanged, or vote for no change in the rate, and we get a 6-2 in favor of a hike, then that could be a surprise, and that could lead to extra volatility in the market where sterling could depreciate. Okay, so we had, as said, the surprise that we had last time. We had seen a huge amount of depreciation from one voting member who unexpectedly voted for no change. If we get 2 voting members voting for no change, where it's a 6-2 vote instead, then that could be we could see potential move towards the downside for sterling or depreciation. Who would be the other voting member that could do that? Well, if we go back a little bit, I mean, it could be Tenrero. That's according to what we're seeing here. She is just on the side of easing policy, or on easing on the dovish side. That could be a possibility, but we haven't really had any indication from herself, really, as to saying whether or not she'd vote for no change, or whether she would look for any bigger hike than 25 basis point hikes, 25 basis points in a hike at the upcoming meeting. So, but again, that could be one scenario to be aware of. Does that make sense to everyone so far? Just want to make sure we all understand that. Hopefully, haven't confused anyone with rate hike expectations. Let me know if you want me to go over that a little bit again, because it can be quite difficult to understand what could happen with the votes that we get from the Bank of England. Right, I'll go back to current slide, and we'll see if anyone does say anything. If you, as I said, if you do find it, but if you want me to go over it again, I can. Okay, right. So markets. So there's also market rates that imply ECB's key rate will be around 200 basis points higher in 3 years' time, compared with 130 basis points for the Bank of England. So you can see that although compared to the ECB, the Bank of England has been faster or quicker in raising its rates to try and rein in inflation, because the ECB has taken longer or has deliberated more with whether to have a rate hike or not. Now that the Eurozone economy is stronger, or in the ECB's eyes is doing well, and inflation, of course, is still very, very high or at record highs, they have a bit more room to play with when it comes to raising rates. And that comes through with the expectations that they've seen. So, of course, themselves, they had said that they would reduce asset purchases to about 20 billion euros by June rather than by October. So a shortening of that timeline of reducing asset purchases. And they said when they do reduce asset purchases, then they'll think about raising interest rates. So now that that expectation has come forward much sooner, that means the ECB has maybe a bit more favorable conditions, or is a bit more flexible with their rates and with their rate decisions compared to the Bank of England, where if they start to raise rates by quite a bit, let's say by 50 basis points, then it could lead to a point where the UK could go into a recession. So the UK is walking, or the Bank of England is walking a fine line at the moment as to how much to hike rates by, and whether or not a 50 basis point hike is warranted in the future, or if 25 basis points is enough. And then you also had some other points as well. So you had money markets scaling back their Bank of England rate hike bets, and now pricing 150 basis points of tightening by the year end from 160 basis points on Friday. Bearing in mind this is last Friday. So there are a lot of, as I said, a lot of chopping and changing in rate hike expectations for the Bank of England, similarly to the ECB, but less so with the ECB and more so with the Bank of England. That is a bit more difficult to kind of see where rates could go. Then April 25th, we had money markets scaling back rate hikes. I said, something that I said was put out last week, which I already said. So, in regards to rate hike expectations compared, and when we're talking about the Bank of England versus the ECB, so bets on tightening have accelerated faster than Bank of England wages. So as we can see here, showing the forward cash rate for in cable terms, for what we can see here, that rate hike expectations have at the beginning of the year had soared quite high, and that all peaked at around 135 or just below 140 basis points, to dropping quite sharply, and then going to around maybe 60 basis points in total. but this is again just this is one thing just to show that compared to the UK and the EU or the ECB, that there's been that the ECB was on a better path, let's say, or as or they're compared to the UK. Of course, the UK started earlier or started first, so then they don't have too much room left to increase rates by, and they're more limited compared to the ECB. But that's just a nice chart from Bloomberg, just showing that there the convergence of trade. Okay, so one thing I did show last night with the Federal Reserve and constant or focuses for inflation and what the UK is looking at. So if we're looking at, we can see with the EU and the ECB, their main focus is energy. Of course, with the Russia-Ukraine conflict, that's blowing out. That's blowing out or inflating inflation in the ECB. And then in the UK, we have more of a mix, to be honest. So core goods is the more or less main focus, and then energy comes second. We have food and then services as well. Of course, the energy market or the energy prices is going to have, I think it's going to have more of an effect later down the line for the UK, as we see the European Union looking to phase out Russian reliance on Russian energy by 6 months, which is not a lot of time to fill up about 37%, around 37% of your liquid natural gas that comes from Russia, and also about around 30% of your crude also comes from Russia too. So not a lot of time left, or not a lot of time given for the ECB to be able to do that. But again, just one other thing, I think if the European Union is going to have troubles with energy, then I think for the UK, we're going to see a bigger impact on inflation readings and when we do get those in the future. And then with the Federal Reserve, more of a mix of everything really, and more so with energy and services, and then you have core goods, and then food being the last thing that is to be affected, or the last or the smallest effect on the inflation reports that we have and have had recently as well. Okay, so the reason why I'm talking about that is because we want to understand what the Bank of England says in their report and what is important, what is their main focus when we do get the monetary policy summary, and also the report as well of why they've set the interest rate at 1% or done a 25 basis point hike. So that's quite important to understand if we do get elements of energy picking up and that becoming more of a focus for the Bank of England. So market reactions, February 3rd. So this wasn't March 17th that we had, where we had the surprise vote for no change, but the market reaction before that. Hey, Scotch and Stocks, welcome. About 15 minutes until the release. Good to see you again. Hopefully you're having a good morning and you're well rested from the FOMC last night. That was a bit of a crazy train ride, really, with the FOMC. I mean, all right, markets were expecting a 50 basis point hike. There was a quick reaction, as expected, of the dollar strengthening, and then markets reversed, and then we'd seen the dollar weakening after the expectation of the rate hike. Of course, it was already priced in, so a lot of the move had happened prior to that release. But going back to here, February 3rd, we'd seen from the first rate hike where everyone was in line with, looking for a vote hike. We'd seen cable strengthened by about 50 pips, and we'd seen on the FTSE 100 decline about 24 ticks. So one thing I want to grab up or grab and show you guys is, of course, the latest report that we've had. If I just bring that for you. Okay. Alrighty. So I know it looks a little bit grainy, but about 10 seconds, about 12 seconds before the release, 10 seconds. And there we go. And that was just bearing in mind, this is the last release that we had. So we'd seen cable or sterling see an overall decline and depreciation and weakening in the currency. It wasn't. We kind of, what I had to do was, of course, with the rate hike expectation, and it coming in line with expectation. Usually, when rates are hiked, you'd see an appreciation in the currency, maybe a modest appreciation, and then the markets go back to their normal trend where they might reverse and go in the other direction. But this took a little bit of time for me to kind of find out what was going on with the market reaction. And the main thing was this, as I said, was the surprise of Cunliffe looking for no change or voting for no change in the bank rate last time. So that was, as I said, took a little bit of time to find. But when we did find them, then of course that move towards the downside made even more sense. So that was that reaction there. If I bring up the deviation, so whilst you're watching that. Sometimes I feel like a teacher. As it's just like, you guys, you can watch the TV, and I'll just grab up and do the rest of my work here on the side. There we go. So if I kind of skip ahead, and then we'll see what caused it. There we go. So that was one of the first headlines that come through from the Bank of England. The 8 MPC members voted to increase the bank rate to 0.75%. Go back. Oops. Skip a little ahead. Touch there. There we go. Just trying to pause that there. So, as said, and then Cunliffe was the only one who wanted to keep the vote or the rate unchanged at 0.5%. So this is what I mean by surprises. Okay, so you had one member out of everyone else that wanted to keep the vote unchanged, and that caused sterling to weaken overall. Now, the surprise today, if we do get a surprise again, hope we don't, because that, of course, that wouldn't be fun for sterling traders if that does happen, or for anyone really. But if we do get a surprise, I think it could be, we might get, the surprise would be if there are 2 members of the Bank of England that vote for no change, and there is a 6-2 vote, as said earlier in the video. That would be the surprise. Markets, as said, are expecting an 8-1 vote. Yeah, Galaxy One says 1 member voting to decrease. Nope. Well, I hope not. that'll be. If we had Cunliffe, it would probably be the most likely one. I think it'd be very crazy if he wanted to cut rates. Go inflation to the moon. Dun dun dun. Yeah. But as I said, if we do get maybe 2 voting members looking to vote no change to the rate, then we could see some depreciation or similar reaction to what we had seen here in the video or in the previous report that we had. We've got about 9 minutes left till the release. I've got to go through the deviations, i.e. the amount on each currency pair moved by. But this reaction, just keep going and going, stayed, let's see. So after about an hour and 20, I think, yeah, about after an hour. Right, that's a bit different. See, after about an hour and 20 minutes, you had, sorry, no, not an hour and 20 minutes. I'm thinking that's usually it's 12 p.m. UK time or 7 a.m. Eastern time, but it was done at 8 a.m. Eastern time this time. So even after about 20 minutes, we were still down on cable, still down on GBP Aussie dollar, and as we had seen earlier, we'd seen an appreciation in the FTSE 100 as well. Okay, so let's go to the deviations then. Now, so March 17th rate hike came in as expected, although we had kind of the dissenter. So you had cable, which had seen a 62 pip move towards the downside. Euro GBP about 34 pips up. GBP CAD had seen quite a... so GBP CAD has seen 83 pips down. GBP JPY about 83 pips down. GBP Swiss franc 64 pips down. FTSE 100 has seen about 33 ticks up. GBP New Zealand dollar has seen about 97 pips down, and GBP Aussie dollar had seen about 92 pips down. So the biggest movement pip wise was the currency pair of the GBP New Zealand dollar, but overall there was sterling weakness, or quite a large amount of sterling weakness in the overall in the markets. Scotch Stock says, is there a sheet for members of the BoE? I think I did show that earlier on. I can show it again for you. I think what you're talking about is where these what are the expectations. But yes, so as said, the biggest mover was GBP New Zealand dollar with about 97 pips towards the downside, and then the cable itself about 62 pips down. But that is there for you to have a look at. I think it might be useful to put in an email for you guys in the mailing list, so you don't have to kind of like listen to me. You kind of take it in yourself and make a better informed decision, considering how I'm going through this quite quickly here. All right, so let me go back to, what was it showing? Let's bring up the expectation on the heat. So that's what the current situation is of expectations of the voting members. Okay, so as I said, Cunliffe or far left, or -1 in the easing territory, or more or less in the no change territory. And then you have all the other members who are more or less on the, or either neutral or on the hawkish side to tighten monetary policy. Bailey himself, also looking for 25 basis points as well at the upcoming meeting, or supporting that as well. Alrighty, so that, I believe, is that there? Perfect. Let's move this out of the way. So let's do a little bit of promo too. So we've got about 5 minutes left. Now, if you want to stay up to date with what's going on in the markets, okay, and what news is coming out, especially as you know, as said with like monetary policy meeting minutes. With monetary policy meeting minutes, then one of the things that we need to, one of the things I think a lot of traders need to understand is that news will move and has moved the markets in the past as well. Okay, as we've seen with the Bank of England, we've seen with Cunliffe voting for no change. That as a headline, if you didn't see it at all or anywhere, didn't hear it, then you might not have known why sterling had seen a movement towards the downside. Or there's the recent headline that we had from von der Leyen as well. Von der Leyen had said that, what she said, right, bring it up here. She said that we'll phase out the Russian supply of crude oil within the next 6 months and refined products by the end of the year. And that led to strengthening in WTI. So again, that's one thing to be aware of, is that news is and can move the markets from what we've seen in the past. So investment banks, what they do is they will have a score called voice or text service, as we do, as we're providing. And what they will do is that they will listen in and use it as a way to manage risk and manage what's going on in the markets. If they see a surprise headline, or let's say, or an economic release where it shows that 2 members have voted for no change, let's say, and you haven't seen that anywhere else, then investment managers will try and manage that risk, or maybe trade the volatility that comes with it, and then use that as a way, for future decisions of what they could do when it comes to moves in sterling. I think for the CME, Galaxy wanted to see me have a probability counter for BoE2. Tried finding that. That's something I can look for later. I know we don't have too much time left. We've got 2 minutes. But that's something that we can I can look for next time. But a lot of the sentiment is looking for a 25 basis point hike from what we've seen from investment banks, and rate hike expectations from the central bank as well, and also economists today too. So I've got my tick strike open. So tick strike, what it does is it lets, so also just bearing in mind with financial juice, you get live real-time news 24/5, right? With what we provide. And also, you can also see the economic releases that we have on the side here. We've got less than a minute, I know. We haven't got too long. But if you do want to get a 7-day free trial of Financial Juice Pro, then that is... Whoops. Clicked on the wrong thing. And that is... that is there in the chat. Okay, about 17 seconds. I'm going to hush my mush. And we're going to see what happens. I'll also keep an eye on the monetary policy report too. Hike, 25 basis point hike, 25 basis point hike as expected. Wow, okay. So 9 members voting for a vote hike. So no Cunliffe. So there isn't any Cunliffe looking for a no change. All members looking for a vote hike there. So 9 members looking for a vote hike. Seeing sterling strengthening there, and seeing Euro GBP weakening. Okay. I hate the Bank of England sometimes. Bank of England members. But hey, that's good. Let's go through some of these comments then. I want to see if I missed anything. So 25 base point hike as expected. So most MPC members think some degree of further tightening monetary policy may still be appropriate in the coming months. And compared to what they said in March, some further modest tightening. They estimate GDP growth of 0.9% in Q1 2022. And March, they'd seen about 0.75. And see around zero growth in Q2 2022 due to extra public holiday and reduced COVID testing. What else we got here? I want to see the vote rate hikes. Okay. So you had 6-3 voted to raise the rate to 1%. Okay, overall, there was a majority. Everyone voted for a rate hike, but I think there's 3 of those that would have probably had looked for a 50 base point hike. That's going to be interesting to see who else it was. So we were expecting Saunders and Mann to look for a 50 base point hike, but if there's 3, here we go. Haskell, Mann, and Saunders voted to raise rates to 1.25%. So there's a increase in the amount of voters looking for a 50 base point hike, which added to which had seen that strong move from sterling. Still seeing strong moves from sterling so far. Let's do a little calculation. Well, we did, and now it's, we're seeing reverse on that. Excuse me. So let's have a little look. Let's see. What should we move by? That's about 35 or 36 pips towards the upside on cable. So not as strong as the previous release that we had, where we had one voter who had, or we had one person who dissented and didn't want to raise, one voter who didn't want to raise rates at all. If we look at cable, if we look at Euro GBP, okay, Euro GBP not looking, whoops, not looking as clear. Let's go down. Should we close that too? Should have closed that for you. All right, let's see what other comments are coming through. So there's about 17 pips towards the downside on Euro GBP. And then let's look at GBP NZD, because that was the bigger move, or the biggest move at last time pip wise, when then we had a surprise. Just want to see what the initial reaction or pop was towards the upside. Okay, so that was about 43 pips towards the upside there. GBP New Zealand dollar. So outstripping the strength pip wise on cable and Euro GBP, GBP AUD. Yeah, it did give it all back, didn't it? Pretty quickly. All right, so GBP AUD. So actually, that candle did finish positive compared to the other candle, the other currency pairs. So far, or more so than cable itself. So that was about 44 pips towards the upside. Just bearing in mind, I'm going. Just want to see the initial pop that we had seen from sterling overall in these currency pairs, but I'll measure the overall movement later on. What else we want to see? What else? We got GBP CAD. We want to have a look at too, and Swiss franc too. I wonder if they've mentioned anything about the gilt purchases, actually. MPC was briefed that corporate bond sales will start in September. Okay, so they're not buying any more bonds. September. And then oh yeah, we also got ConocoPhillips earnings that have just come through, if you're interested in them. Looks like they beat their estimated earnings, and let's see what else they have. Seeing that the FTSE 100 is up, was last up about 1.25% off of the back of that release there, or up so far. Inflation expectations, so those see in 1 year's time inflation at 6.65%. February forecast was 5.21%. Okay, so an increase in inflation expectations. Oof. Oh god. Market rates imply more BV tightening than February. Shows bank rate at 1.9% in the at 1.9% in Q4 this year, 2.6% Q4 23, and 2.2% Q4 24 versus February's forecast, which is lower. That's what you need to know. But 1.2% Q4 22, 1.4% 23, and 1.3% 24. So bigger rate hike expectations for this year, next year, and then the following year. All right. So yeah, that was a modest butterfly spreads. Please don't do that. Whatever you say, whenever you say OMG blew my account, I think you say just kidding. It's like afterwards. Oh, of course I know it's kind of like a joke, but even then, seeing it up in text, like appearing, kind of gives someone like a mini heart attack, like I did something wrong, or I said something wrong. Was that useful for you guys when trading that, or was it not useful, or how did you find that? I hope it was useful. So we've got two bits going on here, reviving some PTSD. So we've got two bits going on here. Just a heads up as well, we had the OPEC JMMC meeting that started. The OPEC plus JMMC meeting that has started, according to a source. So yeah, I think the reason why we would have got that initial pop is, I think, one, you didn't have anyone voting for no change, so that was going to be positive. And then the rate hike came in as expected at 1%, over a 25 basis point hike. So you have the initial pop, similarly to the Federal Reserve with their rate decision last night, where you had the expected hike of 50 basis points to 1%, and then you'd seen it was a quick flash reaction, and then there was a move towards the downside, or it was over basically, and the markets kind of, and then markets just carried on, and then finished looking at the news. What else do we have? I'm kind of surprised though with Haskell and Mann and Saunders voting in favor of a rate hike. That I would have expected maybe a bit of a stronger move from sterling. maybe a stronger move from sterling, maybe if there was. Oh, what was useful? Oh, I don't. Hopefully, you guys. I was just saying, did you find the prep useful that I provided for you guys? You know, were you prepared if you did trade it, or if you were trading it? Right. So let's measure. So I've done GBP done Euro GBP, or nearly. GPNZD. Okay. Just want to get the initial pop. Oops. Stay. Okay. Don't forget we've got the press conference too with Bank of England's Governor Bailey. Surely. Well, in about 20 minutes. There's about 37 pip, 37.5 pip move towards the upside. That initial reaction. That's what showed there. Come on. Okay, that's what showed itself. I want to look at it on a different chart here actually. Or different. I'll find a trading view instead. Let's see. Okay. So yeah, I'll bring it up on here. Show you. So I would have expected this to be the initial move towards the downside then off of the rate hike, and then more or less it's just carrying on its trend, or what it was doing this morning, going towards the, if you can see that, and what it was doing going towards the upside. So that's the FTSE 100 we've seen. Initial. Okay, 9.7. All right, not too much going on there then, tick wise. All right, so GBP Aussie dollar. Oh, we've got some more comments coming through. Andre says, so how would he trade this rate decision? Sorry, maybe missed something. Victor Manuel says GBP Aussie dollar thoughts. Andre says GBP Aussie dollar 1.72 level is interesting. 3 kids and a dad. Hello again. Says we back. Galaxy One says, yeah, the prep is useful. What I like especially is that is that whenever I don't trade because I'm busy or on holiday, I can come back here and get up to date. Nice, good. I'm glad that you're able to I'm able to provide that quick or an hour long web video for you, or live stream for you. Victor Manuel says, yeah, looking how it reacts to 72. Yep. So I think, so with going to Andre then and talking about rate decisions. Now, just talking historically, okay, strictly historically. So what we'd seen last time is when rate hike is expected and is priced into the markets, like we had with the Bank of England and the Federal Reserve. And then you would see a modest move, or we could see a modest appreciation in the currency, as we had seen in sterling. We had seen a modest appreciation. David Senior says, great stuff today, very useful. Thank you very much. I appreciate that. But as said, when you do see rate hike expectations or the rate coming in as expected, then you'd see some modest move towards the upside. As said with FMC yesterday, what we'd seen. So with the S&P, it had initially seen about 46 ticks down, and then 48 up, and then the candle finished 31 ticks up, and the dollar yen had seen about 17.5 pips up, which was its initial move from what we'd seen. I think I might have. I need to rejig that because I think that might be slightly different. What it's seen. And then we'd seen, but yeah, we usually see a quick flash, towards the upside, and then the market kind of does what it's doing now. It'll go back in the other direction. Galaxy One says a macro race outlook forecast market wrap would be very nice. I would even pay for it. Okay, all right, I will take that into consideration. Let me see what I can come up with for that. So that's one scenario, Andre. And then the other scenario is where we get a surprise, like we did with the Bank of England last time, where we had one voting member that looked for no change, whereas everyone else was looking to raise the interest rates. And in that scenario, we had seen sterling weakening. So it could, if that does happen, where one voting member in central bank looks to maybe keep rates unchanged or cut rates in this scenario, which would be crazy, and everyone else is looking to hike rates, then you could get a similar scenario to what we'd seen with sterling in the previous release that we had. And then you get something like today, where no one was looking to change the votes, or no one was looking for no change in the rates, and instead everyone voted for a rate hike. And so that means, so then what you're looking then, okay, is from what we'd seen previously as well from the Federal Reserve, is again the rate hike comes in as expected. Nobody's dissenting or nobody's going crazy or whack with their voting. You'd probably still see a similar, could see similar reaction to what we've seen today. But then the other key focus, where you want to kind of back up that rate hike expectation, is the meeting minutes or the statements that comes out from the central bank itself. If there are any sort of surprises that come through where there is the expectation for, let's say, maybe inflation is too out of control, in let's say in this scenario, actually just reading that here, policy reports show inflation peaking at an average of slightly over 10%. Jesus. 10% Q4 this year. March forecast was around 8% in April 2022. If we see a like maybe out of whack or whack forecast from the central bank itself, or something surprising, again, it could be to do with inflation, let's say, falling or being, or actually, if you would expect sterling to strengthen more, you'd say you'd want to look at inflation expectations soaring maybe even further, or the Bank of England saying that's out of control, then that could help the case for maybe the currency to strengthen. But of course, the different central banks will have different things that they focus on, just like what I talked about earlier on. So you've got the Fed with growth and inflation, Bank of England with inflation, and the ECB, well, their main big dog at the moment is inflation. So that's a key focus at the moment. Hopefully that kind of explained it to you. I don't want to say you've got, if such and such comes out as this, do this. And more so, again, historically, what we've seen in the past, this is, this is, just saying that's what's happened in the past. Galaxy One says, like a journal where you guys collect data and analyze them so that subscribers, traders can get a different view of the markets. Yeah. Okay. Actually, tell you what, why didn't you, just so I remember, and I don't, I'll make it part of my thing today as well. Why don't you email me just of like the list of things that we can do to improve macro arrays or add to macro arrays? And what I'll try and do is I'll try and factor it in or try and make something for you guys that is useful or something that you guys would want. Again, it's all down to what you guys want. Don't forget, so with Macro Ace, of course, and with Financial Juice and TickStrike, there are also going to be other products and software that we're going to be bringing out. So your reviews on those products that we have, and of course, Financial Juice being the main hub or the main place, the main area of where everything happens with news and releases and so on. That would be really great to get your feedback on and how useful it is. Maybe it's not so useful. Maybe there's something wrong. All your feedback is going to really help with us to build the service for you, so you get a better service. Remember, the more you know about what's going on in the headlines and geopolitically or in central banks, the better you can prepare yourself or protect yourself within your trading. As I said, investment banks use it all the time. They always have a squawk running because they always want to be in the know. What's going on? What are central bankers doing? What are politicians saying? Is there conflict? Is it escalating is there conflict in the Middle East, or has Saudi Arabia decided to talking about Saudi Arabia and oil and the Middle East, OPEC GMMC recommends sticking to plan for a gradual oil output hike in June. So nothing boring. It's more boring. Are you going to do NFP tomorrow? Yes, I am. I'll be doing NFP. I'll tell you, I'll put out the link here for you too. I'll be posting out the link anyways in our email later on. If you've subscribed to our mailing list, which you can do, I'll put it here. So again, you can subscribe to our mailing list if you can't see that there, and you can stay up to date with the releases and see the history or see the replays as well of the releases that we had covered. Somehow changed my count. Let me get it up here. Okay, here we go. Shareable link. There we go. So that's tomorrow's NFP, starting at 7:45 a.m. Eastern time. We've got NFP and Canadian employment at the same time. So it's going to be a double whammy of what we're expecting tomorrow. That's it there. And also TickStrike, what I've been running in the background. Of course, TickStrike is, if you pretend that you're in the trading pits and then you all have all the guys and gals, let's say the market open shouting buy, sell, buy, sell, buy 20 lots or buy, such and such. That is translated into this little thing here. Okay, so what we can see here, so if we're looking at GPUSD, let's get the GBP, so we can see, so what TickStrike does, it lets you listen to order flow and also see it visually too. Okay, now we have, as you can see here, it's still going off where sterling is weakening. And what traders tend to do is that they use TickStrike as a way to, again, manage their risk and see if there's still momentum in a currency, in a currency pair. So you have a variation of settings. So you can stick it to 1, which is very sensitive, i.e. you see every little move that happens. You see the market reaction, or every little market reaction that happens, you see that reflected here. And you can put it all the way to, if I can go higher, whoops. Probably can't. You can go all the way to 15. So if you're looking for extreme market volatility and you don't want to hear or see the little moves happening, then you can put the sensitivity all the way up. So tick strike data, that is something that Amar can explain a bit more with you guys. He will be doing a webinar about it in a bit more detail, but what I will do though is there is a little video to kind of go with that, a bit more of an explanation as to what tick strike is, which is there. So you can watch if you click on that link there, you can of course not only get a bit more of an explanation of what tick strike is, but you can also get a 7-day free trial. Okay, so usually if you've looked at the Financials website and you've seen the delayed or you've seen not the delayed version, you've seen this version of tick strike, which is at a higher level of sensitivity. So you're not able to hear all the moves, but you've had a little play with it. If you've had a little play with it as something of interest, then yeah, there's a 7-day free trial. Of course, have a little go. And also you can email Amar at financialjuice.com. But any more questions you have about tick strike as well, which I'll put all there. I know you weren't appreciating me putting his email out there, or of course, if the man gets a lot of emails. But hey, if you want to understand a bit more about tick strike, by all means, do ask us questions. And as said, there is a 7-day free trial. The link to the 7-day free trial above there for you. Also, what would be nice, of course, if macros, if you like our stuff, and like Anthony said, if you really like the market overviews, great job, thank you very much. Then give us a follow on Twitter. We're here. We're building ourselves up. We exist. One day we'll rule the world. But yeah, so go to our Twitter page, give us a follow, and also for this video as well, like and share it, and also subscribe to our channel too, for Financial Juice and for other videos as well. Alrighty, ladies and gentlemen, thank you very much for your participation. I love you guys. Hopefully I've helped you today with an understanding of the Bank of England if you didn't trade it, or an expectation of what to expect from a rate decision. Other than that, as I said, I will see you tomorrow 7:45 a.m. Eastern time with the non-farm payrolls prep, which is going to be interesting to see what the reaction is going to be. But for now, take care, and I will see you then. Goodbye.